Jay, we had a power storm here. Frantic rain. And the power blinked off. Are you still seeing me in the countdown? the sky is not falling. I realize that, no. Tonight, the sky is not falling. Things look grim in the Iran-US-Israeli war. Tonight, the sky is not falling. Things look grim in the Israeli-Iran-US war until a few hours ago when President Trump said he's calling off the bombing tonight. So many things in motion. We're glad you're here for tonight's program. From Chicago, it's Thursday, June 11th. I'm Charles Brown, your portfolio manager, and this is CB3 Live. Tonight, wherever you are, whoever you are, even if you're Chicken Little, I'm here to tell you the sky is not falling. The war between Iran, Israel, and the U.S. took a decided turn 7 hours ago when President Trump called off the bombing for tonight, saying that an agreement is imminent. That plus earnings plus a complete review of 3DS and 4MP will make this a very exciting evening, I hope, for all of you listening. From Chicago, it's Thursday, June 11th. I'm Charles Brown, your portfolio manager, and this is CB3 Live. Tonight, wherever you are, whomever you are, even if it's Chicken Little, I'm here to tell you and convince you that the sky is not falling. Just 7 hours ago, President Trump changed the whole trajectory, saying we will not be bombing Iran tonight and hinting that a deal is, you got it, imminent. Well, we've been hearing that, but maybe it's a little more certain this time because the market certainly took off a huge move in the S&P 500. We have that to talk about, earnings, non-farm payrolls, so much on the docket. It is Thursday, June 11th from Chicago. I'm Charles Brown, your portfolio manager, and this is CB3 Live. We're starting just a little bit late tonight because we are in the middle of a rainstorm with a tornado warning. So my goal is to make it through the end of the show with no more power outages like the reason that we had to restart the opening timer. So sorry about that. But the goal is, again, to make it to the end of this program. If I don't, then that means the rapture came and the tornado took us out, and you can just enjoy this as the last video. But that's not the goal. The goal is to get through all of this because there is so much happening right now. No, the sky is not falling. There are all kinds of good signs in the economy with earnings, with a new Fed chairman, and we're going to celebrate that and cover it tonight. Macro geopolitical stuff, economic data, and then I mentioned earlier the 3DS quarterly deep dive. Remember, we've started a cycle now where we do CG the first month of the quarter, GI the second month of the quarter, and DS and MP the third month of the quarter, and that's what June is in the second quarter. And then we have a viewer question. So one of our longtime viewers, Bruce, sent us a really good question, and I thought a lot of people would be interested in this, so we're going to cover that. I haven't done this in some time, but we're bringing back the word of the day. Perspicacious. I didn't get that. One more time. Perspicaciousness. All right. It is a combination of two words, perspicacity and precariousness. All right. It's a keen insight into instability, risk, and uncertainty, and shifting ground. And it's kind of difficult word to pronounce, but I like this because, first of all, you don't have that many 6-syllabled words. And second of all, it's what my pledge is to you to clearly see as precisely as I can the footing that isn't solid. And that applies to the geopolitical life here in America in 2026. So our monthly market review, macro and geopolitical first, the tape, that's the indicators are coming across the screen at us. Basically, just are turning things upside down. So it's pretty obvious this was yesterday's closing market. There was not enough time, obviously, to get ready for tonight and show you the closing market today, which was dramatically different. And it's up higher even in the overnight market, in the overseas market, as Japan and Germany and France and England will have to adjust their markets to this sudden change of whim from our president. But it's good. It's good if you're long equities, which all of our clients are. So the S&P down yesterday, big time up today. NASDAQ down 2% yesterday, up over 3% today. Just crazy volatility like 2008. And none of it is earnings related or financial shakeout related, like the banks faltering, in 2008, 2009. This is simply all geopolitical, which means it's short term. And that's why I wanted to start off by saying the sky is not falling. That's the thumbnail we used to promote the program the last 10 days. The VIX at 22 is now way below 20. CPI at a 3-year high. So inflation is high. Fed fund rates is on hold. Crude dropped from this $90 to about 86 at the close today. 10-year yield at 4.5, flat after CPI. All right, so what happened with this sell-off? Well, we hit 7,600 plus on June 2nd, and then we fell down to a 73-something handle just yesterday at the close. And what's been the trigger on this? Broadcom. That's ticker symbol AVGO, and yes, it is in our CG program. But that's just the reality of what happens when you've got a lot of vicious selling going on. They go after the market sectors that have been most, paid up or, driven up in price. So this AI semi-rout happened, about a $1 trillion, and then the Iran escalation. That was, again, just 24 hours ago, maybe 28 hours ago. And now 4.5% off the high. Well, now we're only about 1.7% off the high after today's move. It's pretty astounding, but this kind of volatility we do see on occasion. It's not something that any of us really love to see, but of course we like it when it goes to the upside. What this means for me, and that's why I'm back on camera, is that when this market has any kind of news at all, and believe me, it's not like they showed a picture of President Trump sitting there with whoever the new Shaw is or whoever the current mullah is that's going to be signing this deal. They didn't show that. They just showed Trump in the White House with a different meeting saying, oh yeah, it's going to happen. Maybe we'll sign it in Europe. Okay, well, that's actually kind of a good idea, neutral ground. And that's maybe the most promising thing we've heard, but it's not a done deal. And yet the market really kicked into overdrive. So that tells me the undercurrent of this secular bull market remains solidly intact. And that is good for all of us. The sky isn't falling. It's just another chapter in the ever-changing market dynamics of Donald Trump in office. Unless you've been under a rock somewhere, I'm sure you're aware that SpaceX is going IPO, initial public offering, tomorrow. All right, the largest IPO in history. That's the ticker if you want to follow it tomorrow. If you have delayed data, whatever you have, the opening price should open at 135, even if it's just one tick at 135. Now, I will tell you that the speculation markets or the probability markets, Poly market is the biggest player there, is expecting that this $1.77 trillion IPO is going to close at $2 trillion. That's just that's not them predicting it. That's the players in Poly market predicting it. So that implies a pretty significant gain tomorrow of at least 10%. All right, the lead players bringing this SpaceX to the market: Morgan Stanley, Bank of America, Citigroup, JP Morgan. And this would instantly become the 7th largest US company by market cap. Here's the kicker: above Tesla. All right, and both companies owned by the same man. Elon Musk retains 82% of the voting power, and this isn't even really based on the rockets. This is the Starlink revenue that is pricing this, okay? It's the most anticipated public debut in years, I would say in decades, landing on a week with maximum market noise. So even amongst and amid the sell-off, which was until just 7 hours ago, the biggest listing in history prices tomorrow, and it'll be interesting to see what happens there. I'm looking forward to it. We will not be buying it on day one. We've had several clients say, look, can we just buy 1 or 2 shares? If you want to put it in a discretionary account, you can. But I've seen too many times when something IPOs at 150 and closes the first day at 101. All right. So, I mean, yeah, you can buy 1 share or 2 shares or 10, whatever you want. You have the discretion to do that if you have a discretionary account with us. In our managed programs, these are triggered automatically by our system buying and selling engine. So we do plan to add SpaceX to the DS program, which we'll be reviewing tonight, and probably CG as well, maybe not at the same time, all right? And that would be a 2 or 3% position, right? But we just have to see what the stability is. So why is this 1.7 trillion listing moving the market? Because it means it's going to pull money from other names that are out there right now. Could it pull from other tech? Could it pull for the Procter & Gamble's and Abbott Labs? We don't know where the money is going to come from. But if people want to buy this, either they're going to pony up more cash in their accounts, or they're going to say to their asset manager, look, I want to drop this, this, and this, and I want to buy into at least a medium-sized position in SpaceX. So a company this size reshapes the NASDAQ weightings and forces benchmark and ETF buying over time. That means if the stock is added to the S&P 500 at some point, which it will be, and the NASDAQ, which it will be, then that's going to change how people allocate their money in those rest of the stocks that are in there, right? So the sentiment tell right now is that this blockbuster IPO is really clustering here now, peak optimism. All right, it's a signal to respect, not chase, which is why we're not going to chase it tomorrow. All right, I think that the SpaceX and the AI underscores how concentrated leadership has become in a handful of mega cap stocks. That is why we employed the options hedging in here. We had several of you say, well, so far we haven't really needed downside protection. Well, we did in April when the tariff tantrum happened. We did for a portion of time after the February 28th invasion of Iran. And then, yes, the secular bull market is coming back. But do you want to not have any downside protection for when another 2008 comes along, especially those of you who are near or in retirement and see 40% of your net worth wiped out? I don't think so, especially those of you that went through it in 2008. And you can say, well, it always comes back. All right, well, but does it come back in a time frame that works for you and your retirement agenda? So we can have that discussion. We're in the middle of summer reviews with all our clients. If you are not scheduled yet, give Alice a call, shoot her an email, aab@cb3.com, and she'll schedule you. So we're not trading the headline. The VIX is all over the place. Early June, it was at 15. All right, June 5th, it rose to 34%. June 10th, back down to 22. I mean, just crazy volatility. Again, that's why the hedges stay on. So economic data, it's important. The jobs report, CPI and PPI. PPI just landed today because it landed in the morning. We were able to get it into the report. We didn't have any problem with that. So the Fed obviously is a big component too. Employment scenario, basically this was a shock to the upside last Friday. That's why we do the show in the second week of the month so that we can take in the data from non-farms payroll, which is the first Friday of the month. Up 172,000 jobs versus 80,000 estimate. That is a really big beat, and that's great to see. All right, so the market actually reacted a little negatively because that means no rate cuts. Well, it doesn't really matter about non-farm payroll because inflation is still so hot and the Fed is so divided that there's not going to be any rate cuts anytime soon. Now, I've seen some entities out there that are predicting as many as 3 rate cuts this year. There's no way that's going to happen. All right. Unemployment rate 4.3, unchanged. Average hourly earnings 3.4%, which is pretty good. Yields keep mushing up. mushing, crushing up, whatever you want to call it. All right, gains led by leisure and hospitality. We can break out these sectors in a different place, but just know that pretty much across the board, these gains in employment were a surprise to the market. The hiring recession is over, and that makes it a solid report from nearly every angle. That's a good thing, but it also means the Fed has really no reason to cut. And that's the reason why we hedge our programs for situations like this. There he is, Kevin Warsh, the new Fed chairman, getting ready to lead his first meeting. All right, so here's the Fed math. 0 cuts are priced in the markets. There are even some pricing in rate increases. All right, two-way table. The hike is back on the table, as I just mentioned. We're using the QQQ put spreads. We'll talk more about that when we get to the module review on DS. And then for MP, because we're reviewing both those portfolios tonight, we do have a fixed income anchor. So nothing changed our position this past week with all this news. In fact, it validated it. Warsh's first FOMC meeting, definitely no honeymoon. Why? Because he's got a big time decision to make. He's inheriting a 3 3/4% Fed funds rate with a 4.2 CPI, which is way above target. Target is 2%. And we still have oil shocks. Now, today was the alternate, or the antithesis of that, because with this huge move higher in equities, crude comes down. If it looks like there is a treaty signed and the Strait of Hormuz becomes completely clear, and I'm going to add the U.S. controls that, we don't give control back to Iran, you're going to see crude probably plummet to the 70s handle. And that's just nothing but great for the markets, all right? So the April 4th, there were 4 dissents in April, the most since 1992. Whenever you see that many dissents in the Fed governors, that means there is angst at those meetings. Not a good thing. Powell stays in the Fed. He has a seat. He votes, but he keeps his mouth shut. He doesn't say anything, all right? The dot plot is really the event here. So 2 days after the meeting, we'll see. Is it going to be a 4.2 CPI? I hope not. But we can't control that. All we can do is prepare for it. That's why the hedges remain in our programs. So policy, really the only thing to talk about here. The strikes resumed, and we had this slide all ready to go. And with just not enough time to put in a new slide saying, well, maybe the strikes aren't going to resume anymore. They resumed by the time we put the slide in, of course. All right. But right now, at least for tonight, there won't be any bombing. I hope that this is a very short fuse that Trump has, giving them to sign something in, say, 72 hours. And then if not, then the bombing is going to resume. So oil, inflation, these things are what's really just plaguing the market. And even with this, we're still within 2.25 points of lifetime highs, which we hit earlier this month. All right, so the strikes were live as of the time of this slide. They are not now, as of just 7 hours ago. When you wake up, that could be off, folks. Don't be surprised by anything. We have to be prepared for everything. Don't be surprised by anything that could happen. We have to be prepared for everything that could happen that endangers your net worth in your portfolios. And that's what you hire us to do. So on the inflation front, hot headline. I mentioned this earlier, 4.2%, 3-year high. That's just ugly. And it's not something Trump wanted to see a year and a half in, since he made his whole campaign. We got to bring down inflation, bring down inflation. Not looking good. All right. The core rate 2.9 for May. Energy up 23.5%. Food and energy, the most important components in that, because you have to eat and you have to drive and you have to fly or ride trains or whatever you do. We absolutely, without a doubt, have to have food and we have to have energy. Those are the 2 most volatile components in CPI, the Consumer Price Index. If you strip out energy, the underlying trend actually cooled. Core goods, all right, fell 0.1%. So this is an energy-driven market, all right? It's the stories. It says in green. The Iran shock is doing the work, but that again could change in the next 72 hours if a real signed deal is done and the U.S. takes control of the strait. Do not give it back to Iran. The world will not believe it if that happens. All right. The problem with inflation is it goes up like a rocket and down like a feather. And you've seen how a feather drops. And you could use this analogy when you go to the pump. The market rockets up whenever there's inflation or a war-related issue, and all of a sudden premium gas is $5.70. And when it goes down, does it drop from $5.70 to $4.80 to $3.20? It does not. It goes down just like a feather because those people that are making those higher profits don't want to give that up. And the only reason that they do is if there's strong competition. So remember that phrase, up like a rocket, down like a feather? That's the story of inflation. Gas topped $4 a gallon. Again, that's regular, first time in 3+ years. Energy drove 75% of March's gains, and that's not a good gain. That's inflation gain. And this Strait of Hormuz is the choke point behind it. And you might say, well, we don't really care about the Strait of Hormuz for us. Yeah, but there are other people in the world beside the U.S. I know sometimes I think the same thing. If it's not a problem for us, why do we care? Because it's a problem for many, many other people. And inflation bleeds across the different continents of this world. All right. So the Fed can look through this pure energy spike if it believes that Trump is going to get a deal signed. If it lingers, then that's the risk. Energy bleeds into the core of inflation, and that's the line to watch. So the energy spike is the noise, but energy bleeding into the core elements of the signals. Remember, consumer price index is about 20 different inputs, but energy and food are the most important too. All right. We stay short duration. We're not buying long-term bonds because we can't risk that. PPI just came out today, 6.5%. PPI always runs hotter for whatever reason. Core PPI at 0.4, a little bit below, but it's that headline number that really is bad news. Final demand goods, 2.8% monthly jump. All right. Biggest in the series since 2009. I mean, just take that in. 2009, 17 years, okay, in what is supposed to be a lowering inflation environment. At least that's what this administration was really trying to bring us. And of course, they did not anticipate it was going to take this long to end this skirmish in Iran, and it's still not done. I hope today's news puts it on the right foot to getting done sooner. All right, so CPI, PPI, just know that those two numbers are higher than we want. The pipeline, tomorrow's inflation today. So what happens here? We have this largest jump since June 2022. The war is now in the supply chain. So it's just built into the amount of time it takes to get energy from here to there. All right. The wholesale is leading the story here. The producer price feeds consumer prices over time. So if you want to know what CPI is going to be, watch PPI. That's why I always report both of them to you. And PPI, even though there's less of a component, so of the general economy, the consumer is 65 to 70%, 68, I think, what is the last number that I saw, and then government, and then, consumer industry. So if you look at this and realize that what consumers are dealing with inflation is probably more important than what businesses are, that's why PPI, even though it leads, is not as important as the consumer price index. All right. Okay. So this energy shock, how did we get here? It was 2.4% before the war, obviously Feb 28, March 3.3%. That is a major bump. April 3.8 and now 4.2. And that is a combination of the Strait of Hormuz shut down, energy prices rising, uncertainty rising, and just no passages, no goods and services passing through that entity. Now, Russia is trying to figure a way to get their oil and gas across Europe, but it's not an easy fix. They have pipelines, but they really count on that strait. And this is just one of those chokeholds that, frankly, we should have all seen coming, at least not you and I, but those in leadership in this country. So that's the deal on that. Really, this war, we've just got to get to the end of it, guys. We really do. So, All right, I'm going to take a breath here. And again, we're running just a couple minutes late because of the power outage here, but I think I'm still online. So let me check questions here. Florian, good to see you, sir. Hey, Deb, good to see you. You're late, and we were late too. Actually, we started right on time, and then we had to reboot the system because the power went out. So let me get a sip of water. If you got a question, pop it in the chat, and I will get back to you as soon as I can. We're going to talk about DS. All right, so we're on about a 25-second delay between when I'm talking to you and when you actually hear it. So if I see it question pop up in the channel there, I will answer it. So discretionary strategies. Discretion is used when I select the assets, but that doesn't mean we just decide to hold them forever. We have a very systematic trading discipline for all of our programs. All of our programs. All right. But the selection of the assets is discretionary. We'll get into that. I mean, maybe you never know this, but it's good for you to know it now. So that's what DS stands for, discretionary strategies. We are on iteration 42 of that. So I've had 41 previous iterations dating back 7 years. All right. So AI, Mag 7, quantum theme. So quantum computing. All right. That's high level, very sophisticated multi-core processing computing. It's chosen by conviction, traded by rules, buffered by our put spread hedge. We have 10 of the 11 names that are on a buy. So you might say, well, if Microsoft is on a sell, why are we holding it? Because we've made the decision that our core, so now that in January, we changed our methodology where we have a core holding in CG and a core holding in GI, and that is SPY, SPY, that's the S&P 500. We could put QQQ in this portfolio, but we decided not to do that. And again, we have a really strong track record in this program. So what we have is a mix of the Magnificent Seven. You'll see that in the next screen or so. And we never drop them. Now, Microsoft at one point was a 14% holding, down to 10, down to 7, down to 5. 5 is the floor. That's where it says held at floor. Okay. So we're never going to drop any of the Mag 7 stocks. It's just not something that we want to do because we never know when something like today is going to happen. And you've seen these huge moves in NVIDIA even just the last few weeks, and glad we have a nice strong position in that. So this is how we're positioned. And whenever you see the word tape, it just means for what's happening in the market right now, the ticker symbols, the news, everything that comes across that gives us input on how to make our decisions. So NVIDIA is a 15% holding. Quantum is an ETF of quantum stocks, 15%. They lead the book. So that's 30% of the holdings. Mag 7 plus TSM and ASML, those are semiconductor stocks. So it's an all-weather growth engine when risk is on. And we definitely believe risk should be on now, despite the fact that we have this war and crude oil just scaring people. All right. The signals rule, though. Every name is graded on the 3-channel system, which I'll get into. And you've seen this before, but I think it's good for me just to remind you every month or so. 10 out of the 11 confirmed on a buy. Even if we had several of these on a sell, we would probably not hold them. Now, I say probably because if we really get into a secular bear market, we could be raising a lot of cash, no matter what the benchmarks are. And it would take something on the level of 2008, not 2020 and COVID, but 2008 for us to do that. For right now, Microsoft and Meta held at 5%. And then the QQQ, that's the options hedge. It's rolled 4 times a year. We're already in the September options. In August of this year, we will be rolling to the December options. We're always looking further out to get the most protection at the least cost, right? We just shop for insurance like you shop for insurance. We're looking for portfolio insurance, and you get that by being long put options. And then we spread them. So long one and short one. I talked about this in the October show. You guys can go back and look at that, but you see what we're talking about. So here we are, 71% AI and Mag 7. The quantum is 15%. The semi supply, which is those 2 stocks, TSM and ASML, and then 3% in the hedge and cash. So a core conviction, frontier computing, picks and shovels of A&I. They're not really picks and shovels, but you know what I mean. And then a tail buffer. So this is a narrowly focused program, not like CG, not like GI. Those of you that are in this, and I think back to someone who's been this about 2 years and at one point saw his investment double. All right. It just so happened to be one of those times. Last year, not so much, but from 24 to 25, really good time to be in DS. Concentration is the point of this program. And that's why you see such large numbers there for relatively few stocks. All right. The discipline is in the guardrail. The guardrail is the system timing and the put spread hedge. So why do we call it discretionary again? It's discretionary selection and systematic discipline. I mentioned this earlier, but I just want to show you on the screen. So what's discretionary is at my judgment, in my study, I'm picking the theme of AI, Mag 7, quantum, and leading edge semis, which is all technology, let's face it. All right. It's deliberately concentrated, high conviction. It's not an index. We do have a floor. That floor is 5% to protect the strategic Mag 7 anchors. 2 of the 7 are at 5% right now. And yet we still trade by the same systematic 3-channel signal as every program trades. We'll show you that in just a minute. Monthly rebalance, which means we do not trade intra-month unless there is some massive downside problem. We wouldn't do anything intra-month in a melt up. And we may have a melt up here, folks, if President Trump really is serious. Let's try that again. If the Iranians are really serious and the mullahs are willing to basically go along with what Donald Trump wants, all right? But we don't do any overrides. A sell is a sell with the exception of companies that are on a sell signal. They keep 5%. Only Mag 7. So if quantum went in the kicker there, we would get rid of that totally, or ASML, etc. All right. So the 3-channel system, you guys have seen this multiple times, but it's good to be reminded. I have, if you see a chart, and I won't show it to you here, but 3 different signals. And I take the one that is bullish first and bearish first. Okay, so just imagine these 6 lines on a chart. And you can see them going higher, and then the ones below are going lower. And whichever one is the quickest one to get into the signal, into the trade, is a buy. If it goes down and touches the bottom one, well, that's a sell, and it stays on that signal for a month, then we're going to exit that position. We're not going to lighten the position, go from 10 to 5%. We're going to sell it and move on. The exception, I've already told you earlier, is the Mag 7. Okay? There it is. That's how it works. I've shown you this in many programs, and I'll do it again for CG next month when we do that review. So there are the signals. Meta actually went on a neutral today. So there are 3 signals, buy, sell, and neutral. Meta is weak right now, but it's definitely a hold. It is at 5%. Okay. So concentrations, and I'm really digging deep into this because the feedback we've gotten is you guys really want to hear what you have in your accounts and how you're invested. So the AI exposure, NVIDIA, Google, Amazon, Apple, Meta, Microsoft, Tesla, those are the Mag 7 stocks, all right? Mega cap stocks. Interestingly enough, the 7th largest stock will squeeze in there between Microsoft and Tesla tomorrow. That doesn't mean it'll be a Mag 7. It's going to take some time. That may be Mag 8. I don't know. Nobody knows what's going to happen. It's just crazy. I mean, do you realize that when the bell rings tomorrow and the price comes in at 150, it's going to be a $1.77 trillion stock. That's 5.2 times larger than Procter & Gamble, which has been trading since the 1880s. Just crazy. And to think that if it's added to the Mag 7 to make it the Mag 8, 2 of those companies are owned by the same man. You just can't write this script. No wonder the rest of the world is jealous about us, jealous of us. Yeah, it's astounding. So at any rate, leading edge semis, 14%, quantum computing, 15%, high growth software, and Palantir, although that position has moved back. Palantir has had some issues. Trying to keep up with demand and government contracts. The hedge has remained at 3%. So we'll walk through all of these. Apple, 8%. I'm hearing thunderstorms out there too, guys. I hope I stay on the air. I'm watching my monitor. I'm still there right now. Love Apple. I mean, I have some problems with how they present their technology, but as an investment, they have been strong for sure. 8% weighting, not as strong as some other stocks here in DS, but they've got new, they just had their developers conference, got a lot of great ideas coming out, new hardware and new software coming out, finally trying to catch up with AI implementation with Android and many other companies out there, but it's a stronghold. Amazon, I mean, they're just doing everything right with AWS, that's Amazon Web Services. And of course, their delivery business, I think they just break even doing that. And they just make their gazillions of dollars on the annual Prime renewals, right? It's kind of the Costco model. So their advertising remains high margin, fast growing. It's just great holding, 11%. This is a new holding, ASML. So it's equipment used to make semiconductors. All right. They have a monopoly. No leading edge chip gets made without its machines. That's pretty cool. You know, that's the kind of position we'd like to see. So the buy is confirmed, the smallest equity weight in the program, but I could see this going higher when we do the July review. I think it's definitely possible we could bump it up a full percentage and maybe pull it from someplace else that is not performing as strongly. Google was on a tirade. We pulled back just a little bit here, just 1.5%. But at 11, really strong. Gemini AI coming on. It's not going to compete with Claude just yet, or Anthropic, but its search is strong. The cheapest Mag 7 on earnings. How about that? The cheapest PE ratio on earnings. So it owns a full stack of software. Definitely want this in our portfolio. Already mentioned Meta. Meta's at 5% because it's just running out of gas, folks. Held it at the 5% floor. It makes its money in AI and advertising. But the virtual reality push that they had pretty much has been a consumer flop. People just haven't wanted to buy the devices. They haven't wanted to put them on their heads and make it part of their everyday life. So, and Apple has a $3,500. Unfortunately, they've set that aside. They don't talk about that much at all because just the whole space for the market, the consumer just has not warmed to that. And Microsoft, hard to explain this really because there's so much going right with them, except that Copilot is really one of the weakest of the AI engines. But their cloud is still super strong, competes with Amazon, really, really well. So we hold on to them because it's a Mag 7 stock. And if they make a huge move, it's much easier to add to a position you already have psychologically. And again, that's the discretionary part. The minute they go back on a buy signal, we're going to be looking to add back into this for sure, because it's just one of the strongest companies out there in the world. Top 4, I think, in size. NVIDIA, enough said. It's the highest weighted position we have, it and Quantum. It's just super strong company. Looks like there's really no end in sight for the growth with this company. Palantir, strong, very high beta. So this volatility can get a little nauseating at time. But reality is they don't have any significant competition, but their AIP commercial traction plus a deep government backlog drive its best-in-class growth. Hard to get more orders, though, when you're so backlogged to be able to produce what the company needs, what the customer wants. So Quantum, this is a hold at 15. This just get access. This is a great ETF, gives us access to the entire sector of quantum computing, diversified exposure. We just really like it. The buy is intact. It's sized along. So these two stocks together, NVIDIA and Quantum, well, a stock and an ETF, sized together, co-anchor the growth sleeve, which is, really performing well. Tesla at 6%. We had this at 5% when it was on a sell, and we bumped it up 1%. This sounds crazy to say, but can you imagine SpaceX actually giving Tesla coattails simply because of the same CEO? I mean, you can't write the script. It's just crazy. But if that were to happen, then we will probably bump this up, 2 or 3% and have to take it from somebody else. So each of these stocks in this portfolio, because we're not going to trade on margin, knows that they've got to perform or they're not going to be sticking around as long as they'd like. TSM Taiwan Semiconductor, really strong stock, not performing as well since we bought it as I would like to see. I could see this, being pulled back for July, but right now it's supply chain core for sure. AI supply, it's a great holding. All right. So the options hedge, we're in September, as I mentioned. This is 2% of the portfolio. So what that means is we set the puts down here. If the market's trading up here, so as the market comes down, those puts become more and more valuable. So you might be saying, well, it sounds like you're driving with the foot on the gas pedal and the foot a little bit on the brake. And that's exactly the perfect analogy. Yes. It's just like having insurance. We're insuring the portfolio from taking a catastrophic loss. All right. What that means on the upside is it does hamper some of the upside. And yet today, CG and GI both beat the market, the SPX, just because the satellites, and we've talked about that concept for CG and GI. We'll get back to it next month because CG comes back around. But the satellites, when they outperform, can offset some of the cost of the options hedging. But when you run an aggressive book in the lineup, the hedge isn't optional. It's the price of admission. Okay. So after we rebalanced for June, we're 97% equity, 11 names, 2% in the hedge, 1% cash. For those of you that look at your nitrogen status when we have our reviews, it's a 91 risk. All right, it's way up there. Give you a perspective, CG is 84, which is also high. GI about 66 right now. All right, so we're where we want to be on this program. It's long-term track record. If you want to see it, just go to the website, look under the performance button and click the DS page. It's right there. All of our programs are updated at the beginning of the month, showing the previous month's performance, all 4 programs, actually 5. So, all right. So MP stands for market proxy. So this is a new program, as in 8-9 months. I've had a lot of clients, a lot of you guys have said to me, you know what? I love it when CG is doing great and DS is doing great. I don't like the downside so much. Do you have a program where I can, follow you and get your counsel on my portfolio and have our financial planning meetings, but something that just more tracks the index with a little bit of downside protection? I said, we can create that. Yeah, we can. So that is what MP is. All right. MP is market proxy. Now, I need to be real clear. You're never going to have the outperformance in this program that we had in 2020. Now, you don't get these years that often, but 2020, CG was up 62% and DS was up, I think, 66%. Just a crazy great year. In 24, CG up 30% and DS up 35%. You're never going to see that in MP, but it's just a little more, attuned to the actual moves of the market. And it keeps you in the market if you're happy with, or at least some of your portfolio is in this. And again, that's a financial planning topic. I'm going to describe what the portfolio does. Whether or not you should have that is something we can discuss with a meeting. And I'm going to get another sip of water here while you guys are listening. Let me check the thread and see if there's anything to do here. And we'll hope that we don't have another lightning strike. No thunder in my audio. Yeah, I've got pretty insulated room here, Doc. Thanks that. And thanks for the comment on the up like a rocket. Yeah, and down like a feather. That's mine. I thought that was kind of cute. Again, when you're going to the pump, you don't want it coming down like a feather. You want inflation going up like a feather and down like a rock. Free market doesn't work that way, but yeah, that's something you can remember. Okay. MP stands for market proxy. All right. This is the program that most closely tracks the broad market. And there's nothing wrong with that. We intend to better what the market does because we have a little bit of a hedge in here, a little bit of bonds, all right? And again, you can look at the performance on the websites right there. So systematic, low cost, broadly diversified. All we use in this program are ETFs. Right now, there are 6, okay? There's no hedge. We're only on version 7, again, because we've only been doing this for 7 or 8 months, all right? Very small expense ratio, all right? So what it is and who is it for? So it's broad market core, U.S. market plus developed international. So there's no emerging markets in here because that's too much volatility for this kind of program. All right, there is international, there is value and small cap value. All right, systematic, diversified equity core, and it tracks the market beta, which means it tracks the market volatility a little bit less than the market volatility. So it overperformed during the downturn in March, and it underperformed when the market went straight up for 8 weeks in April and May. All right. A lot of people go, well, but now it's kind of back neck and neck in June, and I still have you to talk to, and I don't have the drama of your other programs. Well, I don't know about our programs have drama, but that's actually a quote that somebody said. But we are trying to find the winners. We are trying to find winners that outperform the index at all time. And to make sure that we protect to the downside in CG and GI, we have the options hedging. We have that in DS as well, which I just showed you in the previous segment. So this is, again, built on simple and low-cost ETFs, very liquid. I don't know that we'll ever have less than 6, but we could have more than 6 if we needed it. But right now, it's working pretty well. So the beta moves pretty much in sync with the S&P. It's lower volatility, than the S&P, and it has that income sleeve. So this can actually work for people that want to take regular RMD, for instance. We had a client reach RMD age, required minimum distribution age, and said, hey, can I pull out $1,000 a month because I just want to take my RMD periodically? Yeah, we can do that. Really simple. Okay. So everything's on a buy. Again, it's the same 3-channel signal that I've shown you for the last 3 months here, and actually a lot longer than that. So DFSV is U.S. small cap value. So these are small caps that are basically beaten down. And when that happens with small cap, the speculative players come in and bid up the prices. We feel pretty strongly about this, and we've got an 11% weight. Now remember, these weights are going to be pretty high because we only have 6 assets in this portfolio. The bond portion of this at only 3%. When we started, we had this at 5%. In February, we had this at 5%. Because, well, should I say in March, because of the February war declare on February 28, which actually was a Saturday this year. All right, so 3% there just to give a little bit of padding, but this is the component that we use to try to pad the performance of the portfolio. Okay, and SPDW, that's the developed world ex-US. Whenever it says X anything, it means it's not there. So every other place in the world that's developed, that would be Australia, England, France, Germany, Japan. It does not mean Albania and Afghanistan, all right? Those are emerging markets, all right? Too risky for this portfolio. The total U.S. stock market at 37%, SPTM. All right, in a single low-cost holding, we have the whole U.S. market. Think SPY, but it's a little bit broader because it's not just the S&P 500. Makes sense? We could put SPY in here, but I like the idea of having small cap, large cap, and stocks that just are not included in SPY. So they could be NASDAQ. They could even be over-the-counter and pink sheets, but I think that's pretty rare. Could be. All right, so the S&P Value ETF. These are stocks, again, like the small cap value. Value means beaten down, not momentum based. All right. But there are good ideas there if you can buy them at lower prices. So again, using ETFs, we can capture a lot of this performance without having to take a chance on individual equities. That's a 17% weighting. So when you add all this up, it's 96% in ETFs. There's 6 of them for now, 3% in bonds, 1% cash, And the nitrogen level, if you guys, again, like I mentioned earlier, is 71. The nitrogen level of the S&P 500 is 73 or 74. So really close there, tracks it pretty accurately. And the people that have entered this so far really like it. Okay, they don't have all their money in it because they just use this as a way to stabilize when DS and CG, for instance, are not, you know, cranking out a ton of really good winners. All right, and that happened earlier this year, although we're coming back now and really strong. So just an idea is I have some clients that are using MP now as a replacement for GI. They just like the idea of tracking the index and just having one program that's trying to collect extra alpha for them. So again, that's a financial planning question. If you have not had a review with us this year, we put emails out to all of you. So we want you to do that. This is from a longtime viewer, at least for the last few years. Bruce, I'm not going to mention his last name, but if you're out there watching, I hope that you're going to enjoy my presentation here. But you gave me the question, and I have done this before. I'll mention your name too. If you give me a question that is so salient to the crowd that I cover it as its own segment. He asked, how worried should we be about the debt and the interest on it? Okay, so where are we? What's the math? The national debt right now is $39 trillion. That is almost 100% of GDP. The deficit is $2 trillion, and it is really, really important that you understand the difference. The debt is what we owe. The deficit is the additional amount we're going to owe once this fiscal year closes, because the debt just gets added on. The deficit amount converts to debt. All right, let's look at it on the chart. So this 2 is going to be 49. And unless Congress passes a balanced budget, which would be wonderful, whether you like Rand Paul or not, at least he does have our best interest at heart there. Every year that we have a deficit gets added to the debt. Just horrible. And it's not a blue problem. It's not a red problem. It's an every congressman and senator problem that they cannot stop this spending. So the net interest we're going to be paying, according to the CBO, is $1 trillion. $1 trillion. And the cost that we have to pay for this is 4.1%. Now remember, if you're getting a 4.1% yield, right now you're thinking, that's a pretty nice yield. That's a great thing. Why is it bad? Because if you're a government, you're paying someone that yield, right? We're a client of our own government. And there are plenty of other clients out there in the world that come to the US and take our debt because they know we've never defaulted. We've certainly come close, and there's certainly been threats with a government shutdown that there was going to be a bond payment that was missed, but it's never happened. And I don't expect that it ever will, because once the gap between 0 and 1 in the number system is the biggest gap of all. The difference between 1 and 2 and 3 and 4, if you default 1, 2, 3, 4, 5 times. But when you go from 0 to 1, there's an asterisk by your debt offering for years, maybe decades. So they just can't let that happen. So the total net interest will be $16 trillion over the next decade, rising from this $1 trillion that I mentioned above there in yellow. Each move higher in treasury rates compounds the cost on $39 trillion of debt. So if the bond yield goes to 4.2 or 4.3, and it certainly could, that's just killing the US budget, because it means people will come in and pay that. They'll pay for a bond, and they will get locked in on that interest rate if they hold it to maturity. Okay? So it's not a forecasting problem. It's already the fastest growing line in the federal budget. What does that mean? Well, it matters because it's bigger for the first time, as far as a line item on the budget, bigger than everything except Social Security. It's bigger than the defense budget for the first time in history. All right. almost 20%, one out of every $5. Not quite, but it's probably going to get there. One out of every $5 collected in our tax money goes to pay debt. It's crazy. You imagine any of you watching this or friends you know that have an income of 10 grand a month and they're paying $2,000 in debt? I mean, you would think that's just crazy, right? Well, that's what our country's doing. It's inexcusable. Absolutely. It's 3.2% of all the GDP, and it eclipses the 1991 record, folks. That's going back 35 years. So what's the spiral risk? What does that mean? Well, more borrowing pushes rates up. Higher rates pushes interest rates up, which forces more borrowing. It's the chicken egg. It's the perpetual cycle that we just can't get out of. All right? As Trent Reznor would say, it's the downward spiral or the upward spiral in interest rates, but the downward spiral in the solvency of the U.S. government. That's what we're concerned about, and that's why I'm glad you brought up this question, Bruce. It crowds everything else out. Less room for priorities, less flexibility when the next crisis hits. So interest, as I said earlier, now trails only Social Security. And guess what? And this is off the script. Social Security announced 2034 insolvency. If you guys don't do something, we've got 8 years. Now, I don't know about you, but I really don't want to lose a 30% haircut on my Social Security payment. And I'm betting you guys don't either. All right. But that's where we are if this doesn't get under control. It has leapfrogged, meaning the debt, has leapfrogged everything else in the budget. Just insane. What does this mean for your money? So heavier issuance calendar keeps upward pressure on the long end, meaning you just got to keep issuing debt because you need the cash coming in. And as that happens, the price of the bond goes down and the interest rate goes up, which causes exactly the same problem that I just discussed with you earlier. All right. All right, a term premium rebuilding into 10s and 30s. So we're on the short end in our programs here. All right, if you look in the second column, we collect coupons at the short end. Short end means short duration, 1, 3, maybe 5, but not really. 1 and 3 and 4 year debt, IGSB and sGov. sGov is in the GI program. So we avoid extending into long bond price risk because, again, what happens? As this vicious cycle keeps going on, the downward spiral that I mentioned earlier, quoting Trent Reznor. All right, so when that happens, it just makes the long bond, the 30-year bond, less and less desirable. And income without the rate shock exposure is where we want to be in short term. So our own real engines are productive. These are the engines in our portfolios. They're cash generating. And the hedges stay on because of the volatility, that everything that I just described, this downward spiral, okay? We can't fix the deficit, but we can position for the higher for longer world that it guarantees. Thank you, Bruce. Great question. Folks, that's it for tonight. I think we made it to the end here without the lightning taking us out. If you are new to the program, please subscribe to us on YouTube. Click the little button and you'll be notified whenever we go live. I tweet every day, sometimes multiple times a day. You can see it on Facebook, X, and LinkedIn. The next show, take note, is Wednesday. We've never done a Wednesday show. I will be out of town on July 9th. So we're moving it one day earlier. We'll still have all the regular topics and a keen view on what's going on in the employment market, because the week before will be the employment number. All right. My podcast, still doing these on a semi-weekly basis. We're working up at the 2-year point now here. Let me know if these help you guys. I try to get out there so when something happens, like for instance, this IPO, I'll probably talk about it on Monday on my podcast, if it really moves the market, or if we really have a peace deal. And if you see the market move huge either way, rather than do a show, I usually come on and I do a podcast. So that's audio only. You can see them on our website. We're going to be adding a Substack feed by the next month. I think by the July show, I'll have that live for you. So you can see it on any of these platforms, Spotify, Apple, Amazon, or wherever you get your podcasts. Our word to close: for far more money has been lost by investors preparing for corrections or trying to anticipate corrections than what has actually been lost in the actual corrections themselves. What does that mean? Fear itself is the biggest detriment, not the actual corrections. Peter Lynch, brilliant fidelity manager of money in the 80s and 90s. When volatility rises, the strategy matters most, pardon me, and the discipline does too. And as we always end every program, for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. Well, it has been not the easiest of times to have a sound mind because of things this administration is doing that maybe I will be good for the world in the long run. For right now, it is making things haywire in the markets. And that's pretty much what we're limited to doing here. I have political opinions that I try to keep to myself. We want what's best for America. We want everyone to have an opportunity to succeed. I can say virtually everyone on this call or that will be watching the replay is among the top few percent of blessed people in the world. And the reason we are is because of this great country. And I'm reminding you that our 250th anniversary of the signing of the Declaration of Independence, 250 years ago, will be July 4th. And I hope that you celebrate. We're having a big celebration here with a party, fireworks watching the parade, cookout in the afternoon. It's just great to be part of that. We look forward to see some of you coming to town just before that. That should be wonderful. We'll see you guys there. And if you got any questions at any time, cb3@cb3.com. Enjoy your summer. I'll check back with you midsummer. Until then, remember that at CB3 Financial Group, we don't just manage your assets, we become one of them. God bless you all and see you soon.